no one expected this. One day, American beef producers were exporting over $1 billion worth of premium meat to China. The next, the door was slammed shut. No warning, no gradual phase-out, just a complete and immediate halt. The official explanation? Food safety concerns. But those in the know saw through the facade. There were no contamination scandals, no quality alerts, no systemic violations. This wasn't about safety. It was about leverage, about power. And it caught American farmers completely off guard. To understand the depth of this rupture, we had to go back. In 2003, a single case of mad cow disease in Washington state triggered a worldwide reaction. China, along with dozens of other nations, immediately banned U.S. beef imports. For nearly 14 years, that market remained closed. American ranchers spent over a decade rebuilding trust, brick by brick, investing millions to meet China's high standards. New inspection systems, changes in feed protocols, improved shipping methods, every detail was scrutinized to regain access. And eventually, it worked. In 2017, the Chinese market began to reopen. Slowly at first, then with increasing momentum. By 2020, as China's middle class grew and demand for protein-rich diets surged, U.S. beef found itself back in the spotlight. Exports to China exploded, reaching $1.2 billion a year. For many ranchers, this wasn't just another market, it was the future. Entire operations were restructured to serve Chinese demand. The belief was that the market was stable, that the hard-fought gains were here to stay. But geopolitics has no regard for agricultural optimism. In 2025, without a single quality scandal or policy breach, China abruptly canceled over $500 million worth of U.S. beef shipments. Products already en route were turned away. Contracts dissolved in an instant. Ranchers who had tailored their breeding and feeding practices to Chinese preferences were left with surplus inventories and no buyers. The blow was immediate and devastating. The catalyst? Washington's decision to impose new tariffs on Chinese electric vehicles. In response, Beijing didn't retaliate against automakers. Instead, it hit agriculture, a sector with deep economic and political roots in key U.S. states. Texas, Nebraska, Kansas, regions that helped build the American cattle industry, suddenly found themselves collateral in a trade war. The message was clear: play politics with trade, and we'll play politics with food. The consequences rippled far beyond the ranch. Feed suppliers lost orders. Trucking companies laid off drivers. Cold storage facilities built specifically for Chinese exports sat empty. Small towns that had briefly revived thanks to the beef boom were thrust back into economic uncertainty. And the pain wasn't limited to those directly exporting to China. Domestic markets were flooded with premium beef, driving down prices and hurting local businesses. This wasn't just economic. It was personal. Ranchers who believed they had secured a long-term future watched it unravel overnight. But while the U.S. was reeling, another player was already moving in. Russia. If you'd like, I'll continue with the second part, focusing on how Russia filled the void and what it means for the global food and financial systems. Russia didn't hesitate. Almost immediately after China canceled its contracts with American suppliers, new agreements were signed with Moscow. And not just token shipments. Russia committed to delivering hundreds of thousands of metric tons of beef annually. While American producers scrambled to reroute supply, Russian exporters were already docking at Chinese ports. This move wasn't improvised. For years, Russia had been quietly preparing for a moment like this. Since 2014, after being hit by Western sanctions, Moscow turned inward, heavily investing in domestic agriculture, expanding livestock programs, and courting Asian buyers. With state subsidies, modernized meat processing plants, and logistics corridors stretching from Siberia to Shanghai, Russia positioned itself as a viable alternative to U.S. suppliers. Now, the timing couldn't have been better. China, in turn, got exactly what it wanted: a politically aligned, reliable source of beef that wouldn't use tariffs or ideology to disrupt trade. The price wasn't necessarily lower, and the quality hadn't yet matched American standards, but in the eyes of Beijing, consistency and sovereignty mattered more than taste. And unlike the US, Russia was willing to structure deals in yuan, bypassing the US dollar entirely. This wasn't just an agricultural shift, it was a tectonic change in global trade dynamics. For decades, the US dollar had been the backbone of international commodity transactions. Now, a major agricultural trade route had moved to a BRICS currency. This small but symbolic move sent a ripple through currency markets and food futures. Meanwhile, American ranchers received little support from Washington. Aid programs were slow, disorganized, and riddled with bureaucracy. Some regions received emergency funds to buy back unsold beef, but it was a drop in the bucket. Others were told to diversify markets, but without real infrastructure or international agreements in place, most had nowhere to go. Latin America? Already saturated. Europe? Facing its own food inflation. Africa? Promising, but unprepared to handle US scale. As producers cut costs and laid off workers, anxiety turned to anger. Farmers' associations blamed the administration for escalating trade tensions without a fallback plan. Protests broke out in agricultural capitals. Some threatened to close down operations entirely. Others began looking overseas, not to sell beef, but to move themselves. Paraguay, Brazil, and even Australia saw a spike in interest from U.S. ranchers looking to relocate their businesses to friendlier, more stable environments. The economic fallout began to bleed into the political arena. Rural voters, once staunch supporters of traditional parties, began turning against establishment candidates. They saw the collapse of the beef industry not as an isolated misfortune, but as the latest betrayal in a pattern of neglect. And all the while, Russia and China celebrated their deepening alliance, solidifying a new food corridor, expanding influence, and sending a message: the world no longer needs to rely on America. And yet, this crisis was only a symptom of something larger. No one in Washington wanted to admit it out loud, but behind closed doors, the concern was growing. This wasn't just about beef. It wasn't even about agriculture. What had just happened was a quiet demonstration of how vulnerable the United States had become in global trade, and how quickly that leverage could shift. For decades, the U.S. economy had operated under a kind of unspoken assumption that its dominance in food, finance, and diplomacy was too deeply entrenched to be meaningfully challenged. That if a partner pulled away, another would rush to take its place. But now, one of its largest agricultural industries had lost a vital market almost overnight, and no one came knocking. Instead, rival blocs solidified. BRICS nations, Brazil, Russia, India, China, and South Africa, accelerated efforts to create parallel food, finance, and trade structures. New agricultural exchanges began pricing meat and grain in non-dollar currencies. Ports in Southeast Asia started upgrading facilities specifically to receive Russian and Brazilian goods. And African buyers, once tethered to Western suppliers, began signing long-term agreements with China and its partners. Back home, the American narrative was breaking. The media offered surface-level analysis, some blamed Trump's tariffs, others pointed to Chinese aggression, but few were willing to connect the dots. That this was part of a larger, coordinated strategy to slowly weaken U.S. dominance without ever firing a shot. Not through war, but through trade routes, food chains, and currency settlements. The symbolic power of beef had been underestimated. In rural America, cattle is more than just business, it's identity, legacy, land. When those exports collapsed, it wasn't just ranchers who suffered. Banks felt the shock as farm loans went into default. Equipment manufacturers saw plummeting orders. Insurance companies began recalculating agricultural risk, raising premiums or pulling out altogether. And in Washington, policymakers scrambled to respond. Emergency meetings with trade partners were called. Appeals were sent to allies in Europe and Asia, urging them to increase purchases of American meat. But the trust had already cracked. To many foreign governments, the U.S. looked unpredictable, liable to weaponize trade, sanction at will, or abruptly rewrite agreements for political gain. That instability pushed buyers further into China's and Russia's orbits. Meanwhile, Russia, flush with its new $1.2 billion deal, didn't stop at beef. It offered expanded wheat exports, pork shipments, and strategic food storage deals, again, all in non-dollar denominations. China agreed. So did parts of the Middle East. Quietly, a new axis of food power was forming, one that excluded the United States almost entirely. And while the numbers grew, so did the implications. If agriculture could be peeled away from America this easily, what industry would be next? Tech? Semiconductors? Aviation? The once unthinkable began to feel alarmingly possible. In the halls of government, behind polished press releases and prepared statements, there was fear. Not panic, not yet, but an awareness that the rules had changed. That a new kind of power had emerged, one not based on military strength or GDP alone, but on resilience, cooperation, and a deep understanding of how to starve an empire without firing a bullet. And for the millions of Americans watching their communities hollow out, once again, this felt familiar. Another promise broken. Another boom gone bust. Another future that wasn't coming. And still, this is only the beginning.